Hi, today's topic is accounting methodologies have come to an end. According to the High Court of Australia in Place of Dome Inc. case on the 5th of December 2018, accounting methodologies have been rejected as being a reliable indicator of value. The High Court has rejected the methodologies of balance sheet valuation using top-down and bottom-up approaches, which is the difference between tangible and intangible, discounted cash flows, the income approach, and future maintainable earnings, and the choice of future values based on futures markets, which can never be proven, and also the application of a multiplier. These methods have never been reliable indicators of values, yet have been used for over 100 years in defiance of the legal industry and have fooled all the top legal minds constantly. I have experienced and fought against such stupidity for decades and detailed how wrong these methods are in my book, which was published prior to the findings of the High Court. Never in my wildest dreams could I imagine any High Court justices being able to see through such rubbish. They haven't for decades, but they have now, and it is out in the open for all to see. The High Court justices should be commended for their incredible insight and acumen that others have failed to see. Therefore, it is now time to present a new methodology that is provable, safe and reliable, and is based on all major legal findings of the past. Courts, commercial and financial markets need accurate and reliable assessments of value, both tangible and intangible, and needed in real time, and the methodology must have the backing of the legal industry. Valuation should be left to those who know how to value all assets, both tangible and intangible. To write a report without training and call it a valuation is fraudulent. Accountants are not trained in valuation techniques. In fact, they have no idea how to value tangible assets such as inventories, plant and equipment, property rights and interests, and their own standards declare they have no idea how to value intangible assets such as goodwill, IP, brand names, etc. So why do they do it? They know they don't have the training, yet they seek to mislead you without declaring their lack of competence or training. Now on your screen is their methodology. And I'd like everyone to study it, and particularly solicitors. This is it. Although you may see it in various forms, any report using EBITs, EBITDAs, future maintainable earnings, you know you are dealing with a loose cannon or fortune teller. Valuers use actual real numbers of markets, not guesswork. Cap rates and multipliers can never be found in market sales because the first part of their equation, which is on your screen, can never be found. Why? Because there is no access to other financials and you can never be privy to the EBITs or EBITDAs that were used. Always attack the multiplier. It can never be proven. All businesses are different and vary within industries, yet they use the same multiplier for everything. How dumb is that? The moment you see such rubbish in a report, you should attack it, because it is absolute proof it is not based on the law or markets. And why? They have not used market comparison techniques to arrive at the values, nor can they find any comparables to support the multiplier they use. And then they deny the existence of truth because all tangible assets are not represented in a separate format in their reports at market value. Therefore, protagonists that produce reports based on the rearrangement of expenses such as EBITs, EBITDAs, future maintainable earnings based on discounted cash flow is without logic or reason. They ignore the source of revenue streams and always seek to create an artificial return which is not based on any market numbers. They create an artificial return which is misleading, therefore fraudulent. They know no other way. They believe value comes from expenses, not sales, based on market transactions. What utter rubbish! Yet they have been able to fool all the top minds for over a century. Any time an analyst uses discounted cash flows or cap rates in a business valuation report, I recommend you attack it. Cap rates should never be used in business valuations. If you cannot value a business on today's numbers, you will never improve your valuation by trying to predict the future. Discounted cash flow is not a predictor of value. At best, it is a budgetary tool. Always attack where they got their future value from. It is complete rubbish in valuation reports because earnings and expenses are not robust and predictable, such as property returns. You can never prove the income or growth rate, nor the interest or risk rate, and you can never prove the expenses or occurrence dates. Valuation or values must come from markets, not management. It is impossible to value any business without profiling turnover and benchmarking costs. In other words, industry figures. The accounting industry always uses false, fabricated numbers in their reports. Then they lie to courts claiming their document is a valuation. They are not valuers. Therefore, they lack expert witness status. Anyone who has suffered loss due to such reports should sue. All other tangible assets in their reports are ignored because they do not know how to value property, leases and rentals, nor plant and equipment and inventories, and the impacts they have on values. Now, there are three main High Court decisions that should provide guidance to the valuation of business. And the first one is the House of Lords decision in the matter of Muller in 1901, whereby Lord Macnaghten stated that goodwill value must come from a source, and went further to say that it is the attractive force that brings in custom. If it comes from a source, it can be identified and measured. It is not, and never will be, the rearrangement of expenses that the accounting industry pursue. Sales is the only number that is provable. Sales are proof of interaction by the business with markets, but they must be sales with margins and they must be transferable. This is what is missing in nearly 99.9% of reports. If the report is not based on sales, it is rubbish. Then the High Court, Australian High Court in Spencer's case in 1907, whereby it was held what constitutes market values. Values come from markets, not the practice of rearranging expenses based on accounting or taxation knowledge. Then the latest High Court decision in place at Ohm 2018 has rejected accounting concepts of goodwill valuation. It has rejected them based on unreliability. Finally, some High Court justices have got it right. Accounting reports are unreliable, unprovable and misleading at law. So, this is what happens in markets. This is the market value line. And valuers try to find the market value line. All values must come from markets based on sales, and there is only one market value, not differing values as suggested by some. All sales occurring in the marketplace will either be above the line, on it, or below it, and it is best explained as paying a premium or obtaining a discount. It is sales in the marketplace that create value, nothing else. Without sales, there is no markets. There is no market. Yet, the accounting industry thinks it all comes down to risk and return, and how large they can falsify returns and then apply a multiplier that comes from guesswork. This type of method is meaningless. All valuation reports must be based on the law, but accounting reports are not. They are based on accounting and taxation concepts which have absolutely nothing to do with markets. They record prices paid which are never reconciled back to market values. All values and variables or multipliers come from markets and what markets are doing today, not what occurred 20 years ago and not what is predicted into the future. Therefore, if there are no markets, there is no value. The coronavirus should have taught you that. I have attended accounting lectures whereby most hold the view there are many values and it depends on who is buying, which will alter the price or value. They claim that if a buyer comes from the same industry, they should pay more for economies of scale and synergistic benefits. What utter stupidity! Market forces dictate values. If a buyer is to get the benefits, why would he pay more to someone who is forced to sell? It doesn't make sense. Market forces do not operate that way. The accounting industry try to invent values, but they are not supported by markets. They are a waste of time. Markets change all the time and you must change with them. But most analysts have been using the same multiplier for the last 30 to 50 years. How can their reports be right? It's like the blind leading the blind. Accounting methodologies have always been behind the times. They are based on financial statements and it can only be prepared close to reporting dates. The world needs a valuation method that can value any business on any day, week, month or year. And it must be based on provable numbers, not guesswork. And it's this graphic format which will allow instant visual interpretation. And here it is. It's on your screen. This graphic business valuation worksheet is absolute proof that all the assets, both tangible and intangible, are valued and tabulated in a format that allows debate and is a snapshot of reliable values as at the date of valuation. All assets or components of a business must be valued as at the date of valuation. All tangible assets must be valued at market value, and all intangible assets must be valued based on the sales achieved in the marketplace today. It is impossible to value intangible assets of a business unless the revenue streams have been profiled. In other words, you know where they come from, who they're attached to, and of course benchmarked. You must use industry market comparison to detect fraud. This new methodology is 100% reliable. Sure, you can still attack the numbers, but the methodology is sound and offers graphic evidence that the valuer has undertaken all tasks necessary to produce asset numbers that are reliable, defendable and capable of interpretation by all involved in the marketplace. And they can still exercise their judgment based on the numbers supplied. It is clear, now if you refer to what's on the screen, that the accounting industry does not know how to value goodwill. They have been trying for decades and they have renewed their interest in finding answers to this issue by transferring it to their UIG group, or Urgent Issues Group, but without success. They will acknowledge purchase goodwill, but they never acknowledge internally created goodwill, which is another sure sign there is no consensus within the accounting industry whatsoever. The world's leading universities should be the first to tackle and rectify this massive shortfall in business valuation methodologies and should consider all new approaches now that the old ones are dead. If an accountant walks into a court with his report and claims it to be a valuation, he or she has just misrepresented the truth. If they then claim that the contents of the report is a valuation, he or she is lying. Accountants do not qualify as expert witness status in business valuation methods because they are not valuers. Accounting methodologies are finished. They were never relevant. They are unprovable. They confuse, mislead and defraud the adoptees of such advice. To be relevant in today's market, you should learn better methodologies rather than try to defend a foolish method. The accounting industry has never been able to understand goodwill assets, full stop. That concludes today's presentation. All of the above can be found at valuationworld.org, and I hope you get your copy of my book soon. Thanks for watching.